You know what? Most people spend their entire working life paying tax and thinking that the moment they retire, they're finally free. No more P60s, no more pay slips, no more HMRC breathing down their neck. Just the pension, the garden, and a bit of peace and quiet. But here is the brutal truth that nobody tells you. The moment you retire, HMRC doesn't lose interest in you. If anything, that's when things get more complicated. Because retirement doesn't mean you leave the tax system. It just means you enter a completely different part of it, one that most people have never had to deal with before, with completely different rules, completely different traps, and some very specific things HMRC expects you to do straight away. And the reason most people miss them? Because nobody explains them in plain English. So today, we are going to fix that. We are going through 8 things HMRC expects you to do the moment you retire. Most people miss all of them, and missing them can cost you hundreds, sometimes thousands, sometimes even tens of thousands of pounds. Whether that's money you owe HMRC that you didn't know about, or money HMRC owes you that you never claimed. Let's get into it. Number 1. Tell HMRC you've retired. Not just your pension provider, not just your employer. HMRC directly. Now you might be thinking, surely my employer sorts all of that out. And yes, your employer is supposed to let HMRC know when you leave. Your pension provider is supposed to notify them too. But here is the thing, and this is really important. HMRC's own guidance says the year you retire is when their systems are most likely to struggle with changes. These are systems dealing with millions of people at once, and they don't always talk to each other the way they should. If there's a delay in that communication, or if something gets recorded incorrectly, you could end up on the wrong tax code from day one. And a wrong tax code from the very start of your retirement means you're either overpaying or underpaying tax every single month. Every single month. So what should you do? Contact HMRC yourself. Don't just assume someone else has handled it. You can do it through your personal tax account on the government website, through the HMRC app, by phone, by letter, or by email. Keep a record of whatever you do. Note the date, the time, who you spoke to. Write it down. Because if anything goes wrong later, you're going to want that evidence that you did your bit. This one action, this one conversation with HMRC, can prevent a domino effect of tax headaches that follows you for years. So do it. Don't wait. Number 2. Hand your P45 to your pension provider immediately. A lot of people don't know this one. When you leave your job, your employer gives you a form called a P45. It shows how much you've earned that tax year, how much tax you've paid, and what tax code your employer was using. Most people stick it in a drawer and forget about it. But that P45 is crucial. Your pension provider needs it. When they start paying your pension, they use the information on your P45 to figure out what tax code to apply to your payments. If you don't hand it over, they have to fall back on a default approach. And that default approach is almost always going to result in you being overtaxed in those early months. Think about that. You've just stopped working. Your income has changed completely. You're adjusting to a new budget. And then your pension comes in, and it's lower than it should be because you've been taxed too much, because you forgot to hand over a single piece of paper. So when you get your P45, the very first thing you do is send it to your pension provider, not in a week. Not when you get round to it, immediately. Number 3, check your tax code. And don't just check it once. This is something you need to keep on top of. Your tax code is that sequence of numbers and letters that your pension provider or employer uses to work out how much income tax to take off your payments. Most people working a regular job are on the standard code, which for this tax year is 1257L. That code means you get the full personal allowance of £12,570 tax-free, and tax is only charged on anything above that. But when you retire, especially if you have more than one source of income, your tax code situation gets more complicated. And HMRC doesn't always get it right. Here's a scenario that plays out constantly. You retire. You start receiving your workplace pension. Your pension provider, not having received a P45, puts you on an emergency tax code. Emergency tax codes treat every single payment in isolation. They don't account for what you've already earned or already paid tax on that year. So instead of spreading your personal allowance across the year like it should be, the emergency code just hammers you with tax on every payment as if it's new income. This can result in you overpaying by hundreds of pounds a month. And the specific code to watch out for is anything ending in W1 or M1. If you see 1257L M1 on your pension payslip, you are on an emergency basis. That M1 at the end means they're treating each monthly payment separately, in isolation, rather than cumulatively. Contact HMRC or your pension provider immediately if you see that. The good news is HMRC has been working to fix the emergency tax code problem. From April 2025, they started rolling out a system where they try to automatically move people onto the correct cumulative code faster than before. But the system isn't perfect. People still fall through the gaps, so check your code. Look at every pension payslip. Look at your personal tax account online, and if something looks wrong, raise it straight away. You have up to 4 tax years to claim back overpaid tax, by the way. So even if this has already happened to you and you've been overpaying without realizing, it's not too late to go back and claim what you're owed. Number 4, understand that the state pension is taxable. And understand how HMRC actually collects that tax. Because this one genuinely shocks people. Around 4 in 10 adults in the UK do not know that the state pension is taxable income. 4 in 10. That is an enormous number of people walking into retirement not realizing that their state pension counts towards their total income for tax purposes, just like a salary does. Now, in the current tax year, the full new state pension is about £12,500 a year. The personal allowance is £12,570. So right now, if the state pension is your only income, you're just about under the threshold and you don't pay any tax. But here is where it gets serious and where a lot of people get caught out. The state pension is going up every year. It goes up under what's called the triple lock, which means it rises by whichever is highest out of wage growth, inflation, or 2.5%. The personal allowance, on the other hand, has been frozen since 2021 and is staying frozen until at least 2028. So those two figures are creeping closer and closer together, and soon the state pension is going to cross the personal allowance threshold. Experts expect that to happen from the 2027 to 2028 tax year. The government has said that people whose only income is the state pension won't be chased for that small amount of tax. But if you have any other income on top, a workplace pension, a private pension, savings interest, rental income, part-time work, any of it, then your combined total could already be pushing you into paying tax. And here is the really tricky part. The state pension is paid to you by the Department for Work and Pensions, but they don't take any tax off it before it reaches your bank account. It lands in your account looking completely tax-free. HMRC then has to collect that tax through a different route. Usually they do it by adjusting the tax code on your other pension income, taking a bit more from that to cover the tax you owe on the state pension. But if you don't have another pension income source, or yours is very small, then HMRC might send you what's called a simple assessment letter after the end of the tax year telling you how much tax you owe and asking you to pay it. This catches a lot of people completely off guard. They get a letter from HMRC out of nowhere demanding a payment, and they have no idea what it's for. It's not a scam. It's not a mistake. It's the tax on their state pension collected late. So be aware, add up all your income. State pension plus anything else. If the total is over £12,570, you're going to have a tax bill. Plan for it. Number 5. Check whether you need to register for self-assessment. Most people think self-assessment is just for the self-employed. It's not. There are specific situations where HMRC expects you to file a self-assessment tax return even in retirement. And if they expect you to do it and you don't, you can be hit with automatic penalties starting at £100, even if you don't actually owe any tax. So when does this apply to you in retirement? If your total income from all sources is over £100,000, you need to file a self-assessment return. If you have rental income, you need to file. If you have foreign income, you need to file. If you have significant savings interest that creates a tax bill HMRC can't collect through your tax code, you may need to file. If you run any kind of side business or freelance work, even in a small way, you need to file. And here's a specific one that catches people out. If you take flexible withdrawals from a defined contribution pension pot, which is the type where you've built up a pot of money rather than a final salary scheme, and those withdrawals push your total income over the higher rate threshold, which starts at £50,000, you may end up needing to declare that through self-assessment. The rule of thumb is this. If HMRC can't collect all the tax you owe through pay automatically, they expect you to tell them. Don't wait for them to come to you. Register for self-assessment if your situation requires it. You can do it through the government website. Number 6. Stop paying national insurance, but make sure the timing is right. Here is one that is actually good news, and it's something a lot of people miss. Once you reach state pension age, you no longer have to pay national insurance contributions on any earned income. Not on your pension, not on your earnings if you carry on working. State pension age is currently 66. By the way, from the 6th of May 2026, it starts rising to 67, and that change is phased in and will be complete by 2028. So if you're approaching retirement, keep an eye on exactly when your state pension age kicks in, because it matters for this. The moment you reach state pension age, national insurance stops. But here is the catch. If you're employed when you reach state pension age, you need to show your employer proof of your age, usually your birth certificate or passport, so they know to stop deducting national insurance from your pay. If you don't tell them, they might carry on taking it anyway, and you're just quietly paying contributions you don't legally owe. And if you're self-employed when you hit state pension age, you keep paying Class 4 national insurance contributions right through to the end of that tax year, then you stop. So there's a short window where, even though you've reached state pension age, you're still technically on the hook for those contributions until the 5th of April. Get this right. Know your state pension age. Tell your employer or confirm your situation with HMRC. Stop paying something you no longer owe. Number 7. Understand the 25% tax-free lump sum rules before you touch your pension pot. This is one of the biggest retirement decisions people make, and it's one where getting the timing wrong can be an incredibly expensive mistake. If you have a defined contribution pension, a pot of money you've built up over the years, you're allowed to take up to 25% of it completely tax-free. The rest, if you take it as a lump sum or as income, is taxable. Sounds simple, but here's where it gets complicated. The first time you make a flexible withdrawal from your defined contribution pension, HMRC has historically applied an emergency tax code to that first payment. So if you dip into your pot and take out a big lump sum, HMRC treats it as if you're going to take that exact amount every single month for the rest of the year. They multiply it by 12 and tax you as if that's your annual income. So let's say your pot is worth £100,000. You decide to take the 25% tax-free amount, which is £25,000. The other £75,000 is taxable. If you then take, say, £30,000 from that taxable portion as a single lump sum, HMRC might initially tax you on the basis that you're going to take £30,000 every single month. That is £360,000 a year. You'd be paying 45% tax on most of it. On a single £30,000 withdrawal, some people have had £15,000, £18,000, even £20,000 taken in emergency tax. Money that should never have been taken. Since April 2025, HMRC has been improving how they handle this, and a lot of these overtaxation situations are supposed to be corrected faster now. But you can still end up significantly overtaxed on that first withdrawal while you wait for the correction. What can you do about it? If you're going to make a big one-off lump sum withdrawal, make sure you or your financial advisor plan the timing carefully. If you're taking income regularly from drawdown, the tax situation usually corrects itself across the year. But for single large withdrawals, there are specific reclaim forms you can fill in straight away rather than waiting for the end of the tax year to get your money back. The forms are P55, P50Z, or P53Z depending on your specific situation. If you've been overtaxed on a pension withdrawal, look those up, fill in the right one, and get your money back within about 30 days rather than sitting on it for months. And the total refunded to people who were overtaxed on pension withdrawals since the pension freedoms came in is now over £1 billion. £1 billion. That's how widespread this problem is. Number 8. Check whether your personal allowance is being applied correctly across all your income sources. This is the one that quietly costs people the most money over the longest period of time, and almost nobody thinks to check it. Your personal allowance is £12,570. That's the amount of income you can earn each year completely tax-free. But here is the thing. You only get one personal allowance. It doesn't double up just because you have multiple income sources. HMRC allocates your personal allowance to one source of income, usually your biggest one. Let's say that's your workplace pension. They apply the full personal allowance to that, so your workplace pension is taxed correctly. But then if you also have a private pension or savings interest or part-time earnings, those other sources might be taxed using what's called a BR code. BR means basic rate on everything, no personal allowance, 20% on every single pound from that source. If everything is set up correctly, this can work fine, because HMRC is allocating your allowance against your main income and taxing the rest at the appropriate rate. But if the allocation is wrong, if the allowance is sitting against the wrong income source, or it's been applied in a way that doesn't make sense for your situation, you could be overpaying. The fix is simple, but you have to actually do it. Contact HMRC and ask them to review how your personal allowance is being split across your income sources. You can do this through your personal tax account online, through the HMRC app, or by calling them directly on 0300 200 3300. And while you're at it, check whether you qualify for marriage allowance. If you're married or in a civil partnership and one of you earns below the personal allowance while the other pays basic rate tax, the lower earner can transfer 10% of their personal allowance to their partner, saving the couple up to around £252 a year. In retirement, with fixed pension incomes, this is something worth knowing about. Also check whether the blind person's allowance applies to you or whether you're eligible for married couples allowance if you or your partner were born before the 6th of April 1935. These are allowances that reduce your tax bill, and a lot of eligible people simply never claim them. So let's bring all of this together because there's a lot here. When you retire, HMRC doesn't disappear from your life. If anything, your tax situation becomes more complicated, not less. You've got income coming from multiple places. Different rules apply to each of them. The timing of decisions matters enormously, and HMRC's systems, despite improvements, still don't always get everything right first time. The 8 things we've talked about today are: number 1, tell HMRC yourself that you've retired. Don't assume someone else has done it. Number 2, hand your P45 to your pension provider immediately so they can apply the right tax code from day 1. Number 3, check your tax code on every payslip, every month, and get on the phone if you see an emergency code. Number 4, understand that the state pension is taxable income and plan for that, especially if you have other income sources on top. Number 5, work out whether you need to register for self-assessment, because the penalties for not doing so when you should have are automatic and painful. Number 6, stop paying national insurance the moment you hit state pension age and make sure your employer knows to stop deducting it. Number 7, understand the tax implications of taking lump sums from your pension pot before you do it, not after, because the emergency tax system can take thousands more than it should, and you'll need to actively reclaim it. And number 8, make sure your personal allowance is being applied correctly and check whether you're entitled to any additional allowances that could reduce your tax bill. None of this is complicated once you know it, but here's the truth. Nobody sits you down when you retire and walks you through any of this. You're expected to already know it or to figure it out. And the people who miss these things, they don't miss them because they're careless. They miss them because the system doesn't make it obvious. That's exactly why this channel exists. If this video helped you, share it with someone who's approaching retirement or who's already retired and might have missed some of these. Because the chances are someone in your life is either overpaying tax they shouldn't be, or they have a tax bill quietly building up that they don't even know about yet. Subscribe, leave a comment below telling us which of these 8 things surprised you the most, and we'll see you in the next one.